Morning, everyone, and thank you very much for joining me. This is Morning Market Review. My name is Russell Shaw, I'm a market specialist at FXCM, and my email address is rshaw@fxcm.com. Today is Thursday, it's the 25th of August 2022. I'm just going to bring up our high-risk investment warning. I'll keep this on screen for a few moments. And here's our market commentaries disclaimer. And just finally, our references. Morning, Rob. Nice to have you on the webinar. Thank you, everyone, for joining this morning. Jackson Hole is going to start today. So what Jackson Hole is, if you're not aware, it's an annual symposium. It's effectively arranged by the Fed. It's in a little town called Jackson Hole in Wyoming, and all these sort of central bankers and finance policymakers all descend on Jackson Hole. And tomorrow is the Fed Chair's keynote. It's at 4 p.m. ZA. It's going to be at 3 p.m. UK. And it's an important part of the calendar because it's often used as a platform to announce major policy changes or market moving news. For example, the Fed changing from an absolute target of 2% to an average target of 2%. That was made at Jackson Hole in 2020. Ben Bernanke used Jackson Hole to introduce quantitative easing. And we're in a very complex environment now, something that probably hasn't really been experienced since the 70s, sort of the pseudo-stagflationary environment. And of course, all eyes now turn towards Jackson Hole. That starts today. Good morning, Anna. Nice to have you on the webinar. Thank you very much for joining. Again, thank you everyone for logging in. I'm just going to bring up this chart here. In the meantime, we'll go through the CNBC note on the European market. It reads as follows. European markets set for cautious gains ahead of Jackson Hole. European markets are set to open slightly higher today as global investors await the start of the US Federal Reserve's Jackson Hole Economic Symposium. The Fed's annual symposium kicks off today with Chairman Jerome Powell beg your pardon, I'm getting tongue-tied. The Fed's annual symposium kicks off on Thursday with Chairman Jerome Powell due to deliver a speech tomorrow. Investors will be listening for information on the central bank's monetary tightening trajectory as it looks to rein in inflation and whether interest rate cuts are in sight at the end of the current cycle. Luke Bartholomew, a senior economist, said Powell may use the speech to deliver a mea culpa on his prediction a year ago that inflation would be transitory and to demonstrate that the Fed has learned about price pressures over the past year. US stock futures flat in early pre-market trade on Thursday after Wall Street snapped a three-day losing streak on Wednesday. Investors stateside will also be closely watching Thursday's weekly jobless claims, and we've got PCE, personal consumption expenditure, coming out on Friday, and that's the Fed's preferred measure of inflation. The shares in the Asia-Pacific region, they mostly ticked higher on Thursday, while Hong Kong's morning session was cancelled due to a typhoon warning. On the data front in Europe, Germany's IFO Institute Business Climate and Expectation Survey will be published this morning. Okay, so it's actually a challenging, I'm finding quite a challenging environment. I mean, it's a theme, but yesterday the market did something quite odd, and I think we've got to acknowledge, analyze that. And what's the odd thing that it did? Well, the dollar weakened quite drastically, and it was on a no real news. Let me bring up this chart here. So this is the euro. So this is the euro. You can see the euro is moving up. Before we look at the euro, let's just take a look at the US dollar. And here you can see, so get this sort of massive fall down about sort of between 3 and 4 my time, so between 2 and 3 UK time. I looked for some sort of catalyst in the news. I couldn't really see much. Have I got the right day there? No, I've got the wrong day. Sorry, it was this bar here. This bar here. It was coming down into sort of the London fix. Beg your pardon. It was this bar here. So this was quite odd because it looked as if this actually was presenting a dip, sort of a dip in the uptrend. So let's just explain the dip in the uptrend. We all know that's how we look to trade. So if we can find some sort of primary trend, so in this case, if the primary trend's up, then we want to try and get in on a dip. So this looked like a dip. I'm going to just make this red. This looked like a dip, which would be equivalent to this time here. I'm going to just make it red so that the color codings are there. So here's the dollar dipping, and then it looks like it's coming up quite nicely. And then if we consider what we expect, some sort of impulse move, but that's not what happened. There was a impulse took up there, and then it dropped. And I thought that was quite odd, and the reason I thought it was quite odd, I didn't find any real news to spark that. I've got a theory which I'll share with you in a moment. But it's just a theory, subject to correction. What I was looking at whilst the market was coming down was, of course, were there any movements in the interest rate? So I want to just go down to the hourly here, and the interest rate actually didn't move. So the top here is the dollar. So here's this strange kind of movement over here, right? So this took me by surprise. I went and looked at the real rates to see if there was some sort of big movement down, and there wasn't. So there was sort of a break from what I would expect to be normal movement. And I want to watch this carefully. I think that there is, we're going into Jackson Hole, right? Jackson Hole starts today. We're expecting volatility in the trading session today, but specifically tomorrow when the Fed chair talks. And I think there might be some sort of positioning ahead of that, which is pushing the dollar down and perhaps setting up for some sort of movement as we get the delivery. Again, it's a hypothesis. I wouldn't be able to put it one way or the other, but to me, it's just aware of the next 2 trading days. They're going to be volatile, and with what? Hey, Howard. Rob, yeah. Okay, I also took a natural gas trade yesterday, which I actually didn't, the stop was hit as well. All right, so, hey Howard, morning, nice to have you on the webinar. this was kind of an anomalous trade, but I think there is effectively some sort of behind the scenes positioning going on here. That's what I think is going on. If we take a look at the actual fundamental picture, so I want to go to the daily here with our zones. We typically want to use the zone analysis on the daily. The real rate, which is the middle chart, well, that's still in zone 1, right? So that's still in our upper red, upper blue. In other words, the momentum or the trend seems positive at this case. Moreover, you can see that the Bollinger's are starting to diverge slightly. That, in my opinion, would be dollar supportive. So I think that these pullbacks again present potential opportunity. Now, we can't just willy-nilly go in and take a long position because, number one, we have to see what our system is suggesting. Number two, we have to acknowledge that despite what the system's suggesting, there's heightened risk. Because what happens if the Fed chair comes out and there is a Fed pivot? Well, that would surprise the market. That would push dollar down. That would push the real rates down. And there is, of course, a distinct possibility that may happen. My personal opinion is that the Fed chair will be hawkish. Now, his communication over the last a few times that we heard him speak, I don't think has been particularly clear. So maybe there's going to be some sort of clarity in tomorrow's delivery. There's also ambiguity in not just Fed Chair Powell's communication, but in the Fed communication, which I'm finding disappointing because they usually, I think, are quite good in their communication, but we get Fed officials such as Neil Kaskari pushing for higher rates, but then we have Daly, who is also very influential, saying, well, maybe we should just see what the current hikes are doing, wait for evidence of the transmission there. Are we short? Are we on the right track? And then you've got the various others that are hawkish. So there's just a fair amount of opinion that's coming through, nothing clear cut. And I think that's why the market now is looking at Jackson Hole this particular year being huge in terms of a potential energy. Because if the Fed chair acknowledges a aggressive tightening, or if he pivots one way or the other, that potential is going to turn into, I think, a fair movement, either supportive or a sell-off of the US dollar. That's all tomorrow. At the moment, the interest rates remain supportive. So as long as the interest rates are remaining supportive, the pullback in this dollar to me is interesting, notwithstanding the risk. Another thing to add to this discussion, of course, is the fact that we had the FOMC minutes come out last week. There's no doubt that the minutes were suggesting higher rates, but there's also no doubt that there was an ambiguity that was introduced because there was a communication suggesting that there is concern about hiking too much. And that's where the narrative of this Fed pivot has been introduced. So again, it's just an extra checkbox for the clarity that we need for the market, but it makes trading quite tricky and fascinating. That means if we are going into the be trading, stop losses and risk management. Stop losses and risk management. Okay, so and it's saying, what does behind the scenes positioning mean? Well, think about it this way. Let's just assume, and again, this is an assumption, let's just assume there is going to be a hawkish delivery tomorrow. I think that's my personal opinion, again, subject to correction, that Fed pivot's still very much in play. But let's just say the market expects hawkishness. Well, we would expect dollar to really accelerate off of something like that, wouldn't we, Anna? So in preparation, markets start selling down the dollar, okay? Start selling down the dollar. And they get the dollar at a lower price. And then they'll put in limit orders. Just as the Fed starts, the Fed chair starts speaking, they'll put in limit orders at a fairer value, right? And if there is some sort of reaction, it will, the dollar smash through those limit orders. There'll be a certain amount of slippage because I don't know if they'll be able to be pulled at levels, but the point is it should take off like a rocket. So I think what's happening is, and again, I want to be very clear, this is just a personal opinion, but I think what's happening is that the market setting up for entries tomorrow on the delivery. Does that make sense to you, Anna? Again, I can't confirm that is the case. We'll know after the fact, but that's what I think is happening here, because I can't see any real reason on the rate side. And even if we go down to the hourly, so Anna's asking a very good question. How are they getting the dollar price down to start with? It's a very good question. All right, so I think the best way to answer that, I'm going to refer to an anecdote that comes out of Trading in the Zone by Douglas. I can't remember his first name. It's a classic. I've gone completely blank. Mark Douglas is his name. So Mark Douglas has written a brilliant book called Trading in the Zone. It's not an when I read it the first time, I didn't find it a particularly easy read the first time, but the more you read it, the more you gain from it. It's a very, very good book in terms of risk management and money management. And one of the stories that Mark Douglas relates is as follows. And it says, do the institutions have that much power? So let me tell you the story, Anna, and draw your own conclusion. So the story is as follows. There was a fund manager, and the fund manager hires a technical analyst. And the technical analyst comes into the portfolio manager, and I think they have been looking at wheat or some instrument, and the technical analyst says to the portfolio manager, says, wheat is at a support level. We're going to bounce from here. So the portfolio manager says, so this level is where we should be buying because there is a technical support level. So the technical analyst says, yes, that's what my charts are telling me. The portfolio manager picks up the phone, phones the broker, and he says, sell 100,000 units of wheat or whatever, sell 100,000 contracts of wheat. And he pushes wheat right through the support level. Just to make a point in that, well, you know, your support's there. I'm just going to blast through it. And so the market's going to do what the market's going to do. There is some sense around support and resistance levels, which we've discussed previously, but there is often positioning in anticipation. It's a strategic play. Yeah. So I don't know. So Anna said she's got the book on audio. So I'm not sure if you remember that story, but it's a fascinating story. So yeah, that's what I think might be taking place. Just some sort of positioning ahead of this very, very important meeting. All right. So what does that mean for the other instruments? For the other instruments, well, we looked at euro, and euro has really bounced in reaction to that dollar move, hasn't? But again, these rallies in the broader downtrend, so here's the euro, these rallies in the broader downtrend are extremely compelling because, because the idea is they're suspicious. So if they're suspicious, they give us a potential opportunity to perhaps exploit that. But to the extent the dollar, it would take shorting the dollar en masse. Yeah, I would agree with that. It can't be one person moving the markets like that. I think that there would be a general sort of strategy, I think, ahead of this. Again, it's kind of the way I'm reading the market, because I don't see the fundamental sense in it. Yeah, so what's happening is that the brokers and the traders and the hedge funds, I beg your pardon, the commercials en masse are putting in their bets ahead of Jackson Hole. We're not talking small money here. We're talking significant positioning, right? Because it has to be significant to if this theory has any merit to it, which is obviously capital I, capital F, if it has any merit. But we shall see. We shall see. So Anna's saying, but if my hypothesis is right, we can take advantage of the rocket launches too, of course. But if my theory is incorrect, so that's the risk, right? That's the risk versus reward. The higher the risk, the higher the reward. But there's excess risk here because of just the nature of this particular release. All right. So that's what's, I think, happening. It's very interesting because I think that there is potential here for gain, but, and this is the big deal, there is heightened risk. Now, when we approach the market and we put in positions, I would posit that we generally don't think we're going to lose. I would imagine most of us think that we're going to make a profit on the trade. I think that's just sort of a human sort of nature. So what happens is we tend to act quite strangely when it comes to trading, in that we are optimistic as opposed to pessimistic. But then when it does go against us, we allocate much more meaning on losses than on gains. It's a very strange psychology to try and get your head around, which is exactly what Mark Douglas's book is all about. And the idea here is, if you do decide to take advantage of Jackson Hole, you must have a stop loss and you must have risk management, because if it blows up and pulverizes your stop loss, you're not going to be filled at your stop loss. There's going to be slippage there because it's going to move very fast. So you've got to take that into account. So if you want to only risk, say, 1%, well, you've got to understand your stop's not going to be hit. It's going to be filled at a much lower price or a much higher price, whichever way you're trading. That's got to be so you can't take an excess risk here. Your risk has got to be tight, calculated, making adjustments for the slippage. All right. Jackson Hole is quite a long event. Is there any particular trigger point during the day? I think that the big deal, Rob, is whilst I think there could be elements of volatility that come out, the big plays tomorrow, 4 o'clock ZA, 3 p.m. UK. I think that all eyes are focusing. Is the scalping strategy worth looking at right now? Are you talking, or during Jackson Hole? We can do it now as well. During Jackson Hole. Let me ponder this question. It's a very good question. I think the obvious answer is yes, of course. I think that scalping will be, of course, a potential strategy. Again, the scalping strategy during a massive news release, such as we're going to get tomorrow, I don't think there is a. I think it may actually be disadvantageous doing that, because when we're talking about scalping, we're talking about small wins versus small losses typically, and you want to kind of aggregate those throughout the day. But if you approach the delivery tomorrow and you're using a scalping, and it blows through your stop loss, well, that's going to defeat the scalp, right? Because now you've got a skewed risk reward profile. So that's probably something that we would need to consider. But I mean, intra-day, whilst Jackson Hole is on, I think is something that would be definitely workable. So the way that you would work that, perhaps we'll just go through that very quickly, and then we can conclude. If there are any questions, you can type those through. But I'll just bring up the scalping layout. And again, I want to just reiterate, we are going to do a 5-week workshop on this, starting on the 22nd of September. And we will send out emails. I will obviously send out the link during the webinars, but you will get emails for this. Okay, let's just save these. So we haven't got enough time to run through the actual intricacies of this. I'll do it as quickly as I can, but we're going to do much greater detail in the 5-week workshop. And the idea with scalping is that you want to be in the moment. You want to be trading with the sentiment that's prevalent. So, in other words, the euro. Well, we know the euro is in a downtrend, but the prevalent sentiment's actually up, isn't it? So, scalpers or day traders, we're actually going to market the workshop as a day trading workshop, not scalping. But the idea is you want to be in the moment. So yes, the euro has been absolutely obliterated over the last 2 years, right? You can see it's just been obliterated. Okay, but if we take a short position and we scalp, and we go against the current sentiment, well, are we trading on the right time frames? So what we want to do is we try and get a reading of what the current sentiment is. So what we've got here is a fast stochastic. I don't want any slowing. I don't want any slowing factors. So that's why we use a fast stochastic. And the first element, of course, is to ignore the price chart. We're just taking a look at the fast stochastic. There's no slowing factor. We're looking at a really good momentum indicator, and it's up. Okay, so in terms of, and again, I want to reiterate, this is not advice. I'm not going to take along on the Euro-US dollar today. I'm just treat this as education, right? But you can see that the momentum, the trend of momentum's up. Okay, that's in the daily chart. So we're going to go down to the hourly, and now we want to match up the hourly with the daily sentiment, and the sentiment here, again, we're using the fast stochastic, but we're using it slightly differently. We want to see if it's above 50. Okay? And if it's above 50 and pointing up, all the better, which it is over here. Okay, but now we actually do have to apply the zone analysis. So now we want to make sure that trend, the trend that we're going to focus on, is actually moving in direction of momentum. So on the euro, it actually is. It's in our zone 1 between the upper red, upper blue, right? So now we've got the hourly that is synchronized or in sync with the daily. Is there a possibility of taking some pips out of that? So for that, we're going to go down to the 5-minute. Okay, we go down to the 5-minute chart, and we've got 2 entry techniques here, and they're based on very different principles. The first one is based on a pullback principle, which is, and we use a very, very sensitive RSI. We use a relative strength 2. Now that's very, very sensitive. And on a market scope, we can actually weight it. So we're actually giving more weight to the current reading on the RSI. So I'm not sure if you can get weighted on other platforms, but we use a weighted. I don't think it makes a big difference, but I do think it makes a small difference. So we weight it, and we use a 2 period, and we wait for the pullback. Okay. So the pullback under 30. Once it goes under 30, that's kind of now cocking the gun. We haven't pulled the trigger yet, we're just cocking the gun. And then we would use our reference candles to try and get in. There's a good example of the entry over here. So we've made entry. Here's a good example. So here's pulled back through to the 30 area, right? And here's the reference candle. There's the reference candle. So there's the lowest low, condition 1. Okay. Here's condition 2, 3, and then we'll put in the entry and see if we can take some pips out of that. But of course, nothing's guaranteed. So you'll put in a stop loss. I'd probably put a stop loss in quite deep, and then I would put it in quite deep, and then start moving it up quite aggressively. Again, we don't have the time now to get into the intricacies of that. So that's the first method. The second method, well, you can see we've actually missed. So we've missed the pullback method. We may get a second chance over here. We may, but we may not. So then we have to defer to the second method. So what's the second method? Second method is actually using a stochastic, but this is a different stochastic. This is now a slow stochastic. A slow stochastic here is more appropriate because we're trying to finesse an entry. We're trying to massage our entry. We already know what the current sentiment is in the moment. It's in the moment, it could change, right? So in the moment, it does look as if it's up. So if we get the stochastic moving above 80, okay, that's the entry. You've got to be very, very careful here. Moving into 80, okay, it's got to close in 80. So once it moves into 80, you've got to wait a full 5 minutes to see if it remains in 80. So you need to wait for the candle to close. 3 minutes into the candle, it may be in 80 level, but then the last 2 minutes it might fall out of 80. Well, that's not a signal. Okay, that's a sort of a hit and miss. It's a miss. So you've got to wait the minutes to complete. If you're still in the 8, that's entry. You've still got to put in your stop loss. Still got to have your money management. So that's what we're going to be doing on our scalping course. Now, I want to just reiterate, I'm not going to take this scalp. This is just pure education. I'm actually looking for the opposite. I'm looking to see if I can get in some sort of short here. So, and then hold a sort of a smaller short position. So that's kind of what I'm looking to do. I'm not looking to scalp this. So to be very clear on that was not to be taken as advice. All right. Any questions? Please go ahead and type those in. Any questions? Please go ahead and type those in. I think we should just take a look at Euro, I beg your pardon, our DAX just before we sign off. So let's just go to the DAX. Yeah, here's the natural gas. Okay, natural gas. So I tried again here, and guess what? Got stopped. Let's just go through to DAX. But so similar story here with DAX. We've got a trend. Okay, we've got downwards momentum, and we've got this rally. We've gone way out to R2. I think this R2 here is a decent level to look at. If we reach R3, R3 becomes extremely compelling to me. I'll keep a very, very close eye on that R3. If it holds, I might take a short here as well. But keep an eye on that. Howard's asking, will the 5-week trading webinar be available to view after it's completed? It will be available, Howard, but we're going to delay it. So what we want to do, we're using it obviously as a marketing exercise. So we want a fair amount of people to sign up for it. It will be made available, but there will be a delay between when it's made available and when we hold it. So just want to be upfront about that. All right. Any other questions, guys? Yeah, I'm going to post it to Telegram. I'll always post to Telegram. Well, not always. Sometimes I forget, but 99% of the time I'll put the morning market review on Telegram. But you guys know, of course, I can't put the crypto minute on. So I'll just get this to download. I'll upload to YouTube. I'll put it on the Telegram, and of course it'll be available for you within an hour. All right, guys. I think what we'll do then is wrap up here. If there's any questions, you can send me an email. Otherwise, we shall meet again tomorrow. Have a good day and a good evening ahead. Cheers, guys.